Hi, Rupa. Thanks for coming on the show. The RBI on Wednesday announced a 40 basis point revision to rates. How much more leeway do you think RBI has to tighten the policy?
Uh, See, RBI will now stay in a data-driven mode. Though many people describe this as a surprise move, it was not at all a surprise move for us, at least for me, because you see, they had started signaling from April policy onwards, when for the first time they introduced this standing deposit facility and kept the SDF rate also at a level which was 40 bips higher than the reverse repo rate.
Yeah.
So, and governor in his press meet had very clearly said that henceforth they are going to prioritize inflation. So actually this action which came out of the policy cycle, you have to look at it as a cumulative action where you have to add these 40 bips to earlier 40 bips, which makes it 80 bips
Yeah.
plus CRR hike of 0.5%, which directly has sucked out more than 87,000 crore of surplus liquidity from the banking system. So point is that his action is quite aggressive and taken at the right time. Though they have been saying that they have taken it to control inflation, I think this kind of sudden action was warranted because of too much of volatility in the forex market, and Central Monetary Authority also has to safeguard the value of currency. So that explains it more than anything else.
Now, when we're talking about this, the economic situation in the country is not too encouraging. Don't you think being too aggressive may further push India towards deceleration?
Well, this debate is going on for years, that when inflation is originating from supply side, how can Reserve Bank of India's actions be effective, this and that. I think many times RBI governors and think tanks within RBI have explained it very well, that whatever is the origin of the inflation, once the inflation starts rising, sooner than later it gets generalized, because we have a big organized sector where wages and salaries of people are linked to consumer price inflation. So they get revisions in their wages and salaries automatically, and when they get higher income, it is not necessary that they will spend it only on food items or fuel items. They will spend it on variety of items, so it leads to generalized rise in prices. So it is the duty of central banks, not just in India, world over, to control prices, because inflation actually leads to inequality. In the interest of financial stability, in the interest of protecting equity, Reserve Bank of India has to move towards inflation management.
Now, when we talk about this, it's very interesting because when I circle back to the rates, one of the questions that troubles me a lot is that RBI also said inflation is largely influenced by global factors. And you've just answered this in part. How limited could the impact of a repo rate hike be on prices if it's mostly influenced by global factors?
Well, that's what I said. The source or the origin could be anything. But once it enters your production process, it gets generalized. For instance, your transportation cost. It impacts each and every manufacturing activity and service. So it will increase the retail prices of most of the goods and services. But
Mhm.
if they ignore it, and but they remain in liquidity surplus mode, or what they call as accommodative mode, actually it will lead to inflation rising at a galloping accelerating pace, which is not desirable at all. It will lead to more disruption. Today, just I'll give you an example. We say that inflation is rising, this and that, but still, when you go to marketplaces, you'll find many people desirous to buy commodities at that higher prices, because they have a higher consumer surplus. Lot of middle class and upper middle class people, rich people, have made huge gains during the pandemic from stock market, the investments, etc. And they have huge consumer surplus and purchasing power. Now, if Reserve Bank of India doesn't control demand coming from such people, it will impact everybody. So point is that you have to look at it as an action whose impact will be felt not immediately, but in the next 2-3 quarters, because monetary policy always acts with a lag.
Now, once we have been talking about it, and you started this interview with that point that this was more like expected, but wouldn't an April rate rise been a better thing? Because this seems like a missed opportunity when the market was actually expecting a rate hike at that point of time.
I think you should say February, because in April they acted. As I said, they introduced SDF
Yep.
and they set the SDF rate 40 bips higher than that. In February, they were completely silent on inflation management. But and that time we had divergence also, because some of the monetary policy committee members, they were of the opinion that Reserve Bank of India should move to neutral stance from accommodative.
Yes.
But I look at it differently, because I feel there was too much pressure on Reserve Bank of India because of this massive disruption created by pandemic.
Mhm.
And you see private sector's consumption spending as well as investment spending is still subdued. So whatever stimulus economy is receiving, it is entirely coming from the public sector,
Mhm.
and government is facilitating that by increased market borrowings.
Yes.
So Reserve Bank of India also wanted to see that government gets funds at reasonable rates so that the stimulus will continue. So you see, people will criticize from both the sides, but point is that we have to acknowledge that the economic disruption caused by the pandemic was huge. So that was the need of the hour. And why just you see the experience of global central banks. So nobody in this kind of situation wants to strictly follow any rule-based framework. They would all like to go with the flow and remain data driven, because any kind of forecasting also, to tell you honestly, is ineffective when there is so much of economic uncertainty in the broader environment.
I understand that. Now, I was reading a recent paper by Rakesh Mohan and Parthare, which shows that regulatory forbearance was a significant reason for loans turning into NPAs. Are we falling into a similar trap with MSME credit, given that there has been a forbearance there as well?
See, that possibility cannot be ruled out, because both Dr. Mohan as well as Dr. Parthare, they have seen, many business cycle upturns, downturns, and they are very experienced people. So when they are putting forth a research finding, it has a lot of credibility. But point is that everything depends on the credit underwriting standards of banks and NBFCs, and how they make the selection. Whenever there is a regulatory forbearance, the chances of adverse selection are very high.
Yeah.
I will not deny that. But it's not the case that MSMEs in all sectors are doing badly. For
Mhm.
instance, during the phase of low growth, we have seen that Indian exports have done exceedingly well. Within that, food products, agricultural commodities, textile exports have done well. So
Indeed.
if somebody has focused on MSME units, which have been providing back-end support to these activities, I think they will not have cash crunch or cash flow problems. I will not say that everybody will be trapped with a huge, influx of NPAs. But yes, that possibility cannot be ruled out, because when there is too much of push to lend to a particular sector, definitely, delinquencies go up, and economic growth is still quite fragile, and MSME is the segment which takes the brunt of it. So that possibility cannot be ruled out.
Talking about brunt, this is very interesting. Do you think NBFCs will bear the brunt of rate rises more than banks?
Oh, definitely, because NBFCs, have to borrow from markets to undertake lending. And they don't have this advantage of CASA deposits,
Yes.
current and saving bank deposits.
Yes.
So their cost of funds is very high. So if because of CRR, if the cost of funds has gone up for banks, they are going to pass it on to NBFCs, because NBFCs borrow funds from banks or markets. And we have seen most of the banks have raised their rates.
Yes.
So NBFCs that have planned their liability franchise well, where they have good economic research divisions, which have warned them ahead of the curve,
Yes.
that these kind of actions are coming. So you make a appropriate move towards long-term funds now itself, raise long-term funds ahead of the curve, so that when interest rates start rising, you don't have to raise funds at that time. So NBFCs which have planned their operations well, they will be in a better position. But NBFCs which have not planned their liabilities franchise well, they will certainly face a huge brunt of this rate hikes.
Thank you. Thanks for coming on the show. It was great having you, and we hope to have you back again soon. Thank you.
Thank you. It was a pleasure talking to you.
Same here.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.